Good afternoon, everybody. I'm Brady Dugan, the CEO of Credit Suisse. I'd like to thank you all for attending our conference and attending here at lunch today. It's really personally my great honor and privilege to introduce Larry Fink at lunch today. I think we've been trying to get Larry to come out to speak at this conference for the last 10 years or so, so it's actually great to have him here. It's a real treat to have him here, so delighted to have you here, Larry. I could spend a lot of time on Larry's resume, but I think probably the most, powerful fact is that 25 years ago, Larry co-founded a little startup called BlackRock. And over that period of time, he has built it into a $3.8 trillion asset manager, the largest asset manager in the world, which I think is an incredible achievement, obviously. And I think that says it all. Larry's done that, I think, through tremendous vision, very consistent application of strategy. He's built a great firm while doing that. And I think, actually, one of the things that's most notable is that I think Larry is one of the most respected and admired CEOs in the financial services industry. So I think it's been a tremendous achievement. In addition, and I think particularly relevant for today's talk, I think Larry has been pretty courageous about making calls on the markets. I think, I guess most recently was about 7 or 8 months ago, where Larry came out and was very, very strong on people allocating more money to equities. And that was a time when it wasn't so obvious that the equity markets were going to be as strong as they were. And so I think I even saw Larry the other day. You were interviewed on CNBC last week, and they even admitted that you came out with that call and were right about it, which that's pretty rare, actually, to see them admit something like that. So in any case, it is a tremendous pleasure to have Larry here. And with that, Larry, I'll turn it over to you.
Thanks, Brady. And Brady failed to talk about my first 12 years in the business. And my first 12 years in the business, I happened to get I guess how I should say, a sympathetic offer to join First Boston in 1976. And it was a fabulous 12 years being part of the Credit Suisse group. I have great fond memories of those moments. It was my successes and my failures at Credit Suisse that allowed me to have the vision to start BlackRock. So probably more the failures, and that's why I left. But my failures, not the firm's. And so it's really a deep pleasure to be here. It is a real deep pleasure for me to be, being introduced by Brady, who's been a friend for many, many years, and I am very, very proud to be an alumni of this great organization. So thank you, Brady. So let me talk about the world, and unfortunately, I know I see a media table there, so I don't like even having a prepared speech, but I need to have one now because of the media. So I apologize. I'm going to be a little more formal than I tend to be. So maybe you could catch me during the Q&A later on. But let me start off and talk about a great American tale. Hopefully some of you know it. It's a great story. It's a story about a man named Rip Van Winkle, written by Washington Irving, a very famous story in America. And this is a gentleman who suffered the world's longest hangover. It was a story where he fell asleep after a lot of drinking, and actually he was bowling, drinking more and more and more, and fell asleep and slept for many years and woke up to a new world. And now if we were all a modern Rip Van Winkle and we fell asleep on October 9th, 2007, and woke up today, 5.5 years later, felt rested, really happy. You would have probably, you looked at the financial pages and said, gosh, nothing happened. We're back to where we were. The Dow is exactly where it was 5.5 years ago. But when you look a little closer, you would have seen a lot has changed. I don't need to tell any of us in the room about what we had to deal with over these last 5.5 years. But I think it's an important analogy to think about, because the preoccupation on investing, the preoccupation, what does Cyprus mean for you today, or what does something else mean today? And the reality is, if you're an investor, most of the stuff that we hear in media is truly not worth the time following it. And if you focus on longer term investing, and if you were a little more like Rip Van Winkle, you'd probably be better off today than you were navigating ins and outs and ins and outs. And that, to me, that's an important story, and it's an important component of what I'm trying to say today. But the environment has changed. There have been many losers. There have been some winners. We're in an environment that truly is characterized by low interest rates, more market volatility, extreme short-termism, economic stagnation, and political gridlock in so many parts of the globe. And in many ways, we are like Rip Van Winkle, struggling with a major hangover, suffering from long financial and economic issues. And that hangover is involving some challenges that both affects the causes of several megatrends, both in market direction and investor behavior, which I want to talk about. So there are 3 megatrends that I think will influence where the markets are going, where the world is going. And the first of these megatrends is the aging of our population. This great aging is a defining moment for the global asset management business. It is a global change for our generation. It is going to reshape how the political environment is. It's going to shape our investor behavior, and it's certainly going to be shaping the markets. Life expectancies in the world have gone up significantly in recent years. We have not focused on what the impact is of life expectancy. It's going to further strain governmental budgets, and it's going to be a huge hardship. In fact, longevity will become not a blessing for so many people, but it may be something quite negative. So here we are, spend so much time in trying to improving our lifestyles, trying to improve our health, to live a little longer, to see our grandchildren, and hopefully maybe our great-grandchildren. And yet, we're not spending any time focusing on what does this mean? How are we going to manage our retirement? How are we going to build the nest egg to make that work? And nobody is focusing on this enough. The challenge is actually acutely throughout Asia, and even greater in Hong Kong. The life expectancies for women here in Hong Kong is the highest anywhere in the world, and birth rates are among the lowest. This so-called dependency ratio, the number of inactive people versus active aged residents, is surging, as a percentage of the population over the age of 65 is expected to reach over 26% by 2030. Because people are living longer here and around the world, the need to save is greater than ever before, and retirement portfolios need to stretch a whole lot further. It is my great proposition that what we are missing in retirement today, we have an inadequacy of duration in our assets. We are so preoccupied on the noise that the duration of our assets versus the need of our liability or the elongated life, we have a massive gap between the duration of our assets and the duration of our liabilities. This is going to be a defining moment in the world in the future. This is not just a problem for the individuals. It's going to be a big problem for governments. Our governments, and as evidenced by the behavior in Washington, the behavior in Europe, they are continuing to play short-term politics. They're not willing to address head-on some of the issues They're not willing to talk about long-term issues impacting entitlements. And if you intersect longevity, what does that mean? It means even bigger problems in the future. For the individual investor, too many portfolios are just inadequate. Now, if you also look at one of the major trends, and that major trend is also the transference of the liability of a pension from the defined benefit plan to a defined contribution plan. Now, if you also look at the behavior when the individual has to make their own investment decision, we are finding greater allocation towards bonds, as when the individual has to make these investment decisions, they tend to be a little more concerned about the environment, the noise that they read in the newspapers and on television. And so they tend to invest even more conservatively, over concentration in bonds. And so actually the gap between assets and their liability, their need, is actually greater in defined contribution, where at BlackRock we are projecting a greater asset and liability gap in DC than there is in DB, and as bad as DB is. And this gap is getting greater and greater. This is one of the big reasons why, as Brady discussed earlier, why I'm so bullish on equities. It is the only asset class that will give you the duration for a retirement. And I would also raise a question: if you're 30 years old, 35 years old, or 40 years old, when you have as much as 35 or 40 years left of working, why would you own a 10-year bond? You're just harming yourself. You're not earning adequate returns. And why do you care about Cyprus if your liability is 35 years also? So why is that even part of the debate? Well, even if your liability is 2 months, why do you worry about Cyprus? But that's another story. It sells papers. The second mega trend is this whole utilization of beta. But before I talk about it, let me just touch on one other thing that I think it's important to discuss. And that is, we need to make sure as citizens of the world, to making sure that our governments are focusing on longevity and what that does to entitlements. And that's one thing that I am trying to do more and more and more. Whether I'm here in Hong Kong or where I'll be in Japan later this week or in Beijing this weekend, we need to all focus on this whole issue of longevity. Let me go back now to the second mega trend, and that is ETFs and beta. Obviously, there's a lot of noise around ETFs, a lot of issues related to how this market is expanding dramatically. Much of this has to do with investor confidence, and as investor confidence improves, we're seeing some of this cash moving from the sidelines that's been built up in a number of years, and they're moving to the most liquid products that are transparent, trade on exchanges, like an ETF. Since the beginning of the year, BlackRock has seen over $21 billion of flows in ETFs. 90-something% is all in equities. So we are seeing movement from cash. I want to underscore movement from cash to equity beta. When people talk about the great rotation, there hasn't been any rotation yet. We have not seen really any movement out of bonds yet. And so here we are now, the equity market's quite higher than they were 8 months ago and a year ago, and yet people are talking about the great rotation. It hasn't even begun yet. Where we're seeing the flows are moving from cash into equity beta. This is happening both institutionally and retail. Retail, obviously, it represents a large component of this growth, but at BlackRock, 70% our flows in ETFs are institutional. So we are seeing this whole movement into beta products across the board. We are seeing institutions now looking at beta and using beta for alpha, tactically allocating across products or regions, over-allocating in the, by region, and using the excess over-allocation of beta to extract extra alpha. And so we're seeing a whole new class of investors using beta products for alpha. This is not a substitution for mutual funds. It is a substitution for stock investing. I'll see you a little later. I haven't. And so that's a big issue that we are seeing. So clients in beta products may be 20% allocated also into alternatives, and we're seeing a large component of barbelling between use of beta and uses of alternatives. So we're seeing more and more behaviors towards beta products. I think this will continue. I think you're going to see even actually accelerated flows in both fixed income and equity beta products in the coming year. Which brings me to the third trend, which is really the re-risking that I'm talking about, where we're seeing trillions of dollars of money sitting in the sidelines and are now coming back into the marketplace. So they're moving out of cash, moving out of safe havens, moving into different asset categories, some into credit, some into equity beta. We have seen very little in terms of fundamental equities, but we are just beginning to see that rotation begin into fundamental equities in the most recent few weeks. And one of the reasons why we begin to see more movement into equities instead of fixed income, unlike last year where we saw a lot of money moving from cash into bonds, much of it has to do with the duration risk you have in bonds now. So obviously we've lived in a bond market now that has done quite well for 30 years, but in many categories, especially in the long duration assets, if you had a 19 basis point move in interest rates, you're going to lose your entire year's return. And so now duration is playing a very significant role, and I think that will continue to play a bigger role. And as people start understanding that, that's when you're going to start seeing the great rotation. When you have a 19 or 40 basis point move in interest rates, when people start realizing, when they look at their monthly statements or daily marks, they're going to start realizing that, oh my gosh, bonds do represent risk. It is not a holder of wealth anymore, and therefore I got to start looking at what to do. The other thing that we have to understand, and this is why I think systemically we have to really understand what bonds are going to do. For 30 years, the bond market rallied about 8% a year. It's not going to happen now. So having that ability to 8%, it really was able to allow pension plans, insurance companies to really use bonds as a major component of their investment strategy. That just can't happen now where interest rates are now. Even if duration doesn't move around, you're just not going to be able to meet your liabilities at 2 or 3%. And if you're in credit, 4 or 5%, it's just not going to meet the liability needs. And I would also then say, if you are focusing on your retirement, I would suggest you probably need closer to 7% compounding than 4 or 5. And if the whole world started saying, I only want risk that gives me that accords me a 4 to 5% return, this would be a very large challenge for every economy, because it would mean a greater allocation to savings and less consumption. So this is another issue that we have to be working out with governments. If we see just a continuation of allocation in 4 or 5% interest, and if people start really focusing on longevity, it just means they have to save a greater component of their disposable income. And if that's the case, we are going to have a much greater severe shock to our economies going forward. So the real question is, when will interest rates go up? And it is my opinion it's not going to happen anytime soon. It's not going to happen the next year. I don't believe the Federal Reserve is going to rush into changing their position. We could spend more time maybe later on the Q&A talking about it. But I do believe it's going to happen. We'll see higher rates, but I just don't expect to see higher rates terribly soon. I would also say, even if we did see somewhat higher rates, 75 or 100 basis points, it's going to impact those who own bonds, but more importantly, I think you're going to have that rally in rates, not because of changes in Federal Reserve behavior, but because of rising economic activity, which would justify higher rates, which would then justify higher equity valuations. The final mega trend is about my favorite topic and how I spend so much of my day now, working with regulators and regulation. We are a big believer in having a safer, more transparent market. It's going to benefit all of us. We all should have a market that we can all expect much greater safety. There is no question in my mind that appropriate regulation is justified in providing us more transparency and reducing unwarranted risk. But many regulation now is coming to all of us with various different challenges. What the biggest challenge I see with the regulatory regimes today is every country has their own set of regulation and they're not coordinated. And so actually we could see things fall from the cracks, but more importantly, every country in the world is trying to making sure that their country is protected. And you're going to have some very aberrant outcomes if we don't have our countries worldwide trying to work closer together to have more of a centralized view on regulating the financial system. At this moment, we are seeing behavior in the United States different from behavior from the Euro, different behavior from the UK, different behavior from Asia. And so regulatory environment and the complexity around regulation is a mega trend that we're going to have to live with for a long time. I would also argue, and Brady may disagree with me on this, but I would also argue that our regulators today understand that it's going to be very hard to change the course of our large financial services companies worldwide. In fact, they probably see the merits of having strong financial services, strong banks. And in doing so, though, they're going to actually make sure that those strong banks are not going to jeopardize society. So they're going to actually add more increased regulation. Maybe more countries will follow Switzerland that Brady has to live with in terms of capital charges. But I do believe the regulators are, as they admit that these large banks are good enterprises, but it also means as a result of it, they're going to have increased regulatory supervision, making sure there's greater protection. This all is going to have just a very solid, probably negative impact on some of the markets unless we bring this all closer together. I would also argue we have an imbalance today because we have financial markets being impeded by all the quantitative easing, by having all the central banks buying government securities. At the same time, we have regulators impeding insurance companies and other institutions through Solvency II, Basel III, and accounting regulations that institutions are inhibited by diversifying. So one of the areas where people are moving to is more into credit because they can't buy equities, they can't buy other alternatives. So we're actually seeing a crowding out. So this is an example of some of the unintended consequences that we have because of the lack of coordinated effort by our regulators, whether it's Solvency II, Basel III, FASB, which in my mind, you put those all together, really create some really wicked unintended consequences. So we need to address this. We need to address accounting standards, especially accounting standards when you think about back to pension funds, back to insurance companies. We need to have accounting standards starting to address liabilities. And when you're marking to market your assets, you mark to market your liabilities simultaneously. The problem we have again today with insurance companies, with pension funds, because you mark the annual volatility of your assets, but not your liabilities. Insurance companies are sitting with very short assets because they're more concerned about the annual VAR under Solvency II. Once again, these institutions have a huge gap between their duration of their liabilities and the duration of their assets. Another flaw in our system. So we have become so overregulated, so worried about transparency, we forgot. What is the objective? The objective is to build financial stability through having matching assets and liabilities so we could have what I would call a more secure future and a more secure balance sheet. So I would offer some of these regulatory changes are offering much greater volatility and, more importantly, a much deeper gap between assets and liabilities. And that's going to be one of the great changes and megatrends that we're going to have to face in the future. So, as Brady said, about a year ago I came out with this statement I'd be 100% in equities, which got a lot of play, and everyone said, well, you can't be 100% equities, you can't be, that's not diversified. And what I'm trying to make a statement is, it's not about market timing. It's about getting people to get into the market. the timing into the market. And this is what I think we are so preoccupied on the timing of the market. And that is just such a bad long-term behavior, and it erodes so much of our returns in the future. We have to be much more thoughtful, much more longer term in how we are investing if we're going to build that, that pool of money for retirement. And I do believe people are miscalculating their opportunities for long-term investing, especially the opportunities you have in dividend stocks. So if you look at the 5 or 10 large cap dividend stocks in the S&P, they actually have a shorter duration than the duration of a 30-year treasury. They actually pay you a higher coupon too. So what does that tell you? It tells you, one, getting back, institutions are inhibited to go into equities. It tells you that defined contribution bias is still bonds. And it tells you why, once again, in my mind, why I think stocks are mispriced and why stocks in the future are going to continue to do quite a bit better. So I believe we have to think about risk. We have to think about these mega trends. We need to really think about what are the long-term objectives of investing. And if we spend more time focusing on objectives, less time on timing, less time on noise, we'll all be better off, and ultimately our investors, our clients will be much better off. So I want to leave time for questions, but I do believe it's very important for us to focus on these mega trends. The use of beta, which shocked many people how quickly people are using beta. The whole idea of longevity and longevity of life and how that's going to change the investment behavior. And third, the outcomes of this regulatory environment we're all living with and how that's going to change how we think, how we navigate, how we manage markets, and how we manage long-term portfolios. I think we have to focus on these three trends if we're going to be successful investors. I think we're going to have to focus on these three trends if we are going to be successful fiduciary for our clients' monies. And I do believe the preoccupation on short-termism, the preoccupation on noise in the marketplace is burdening us to such an extent that we as investors, we as governments, we as society have forgotten the basic fact of objective-based investing, and we need to get back to that basic fact of objective-based investing. Thank you, and I'll open it up for questions.
Thanks, Larry. I think we have microphones, so if anybody, just raise your hand. We've got a couple microphones we'll get them over to. So let's take first question here. Second question, anybody over here? Get a microphone to you. Maybe second question here then. That's the first question. Why don't you go ahead there, and the second question will be back here.
I'd be interested to hear your comments about the U.S. situation with the level of debt that the government has, the liabilities that the government owes its citizens over time. It's trillions of dollars, yet the government can't even talk about an $80 billion and get the solution. So, in essence, do you think the U.S. is past that Minsky moment?
Well, I'm probably more bullish on the U.S. than any place in the world right now as an investor. So I think the Washington problem is the only thing that makes me, I would be hyperventilating right now about the U.S. if it wasn't for the stupidity of Washington. But over the course of the last year and a half, we've cut the deficits by $3.9 trillion. It was just done in the wrong way. I mean, the sequester actually does cut the deficit by $1.2 trillion. The revenue increases with about $800 billion, and you had August 2011 about 1.4, 1.6 trillion dollars of cuts. we still have not addressed the basic issue of entitlements and how we deal with entitlements, and this is why I do believe the only way we as societies could deal with entitlements by educating our population about longevity of life and talking about why on earth would you want to retire at 62 when you may have 30 more productive years of life. It doesn't have to, obviously. So I think the whole notion of how we think about our life path has to be readdressed. It has to be readdressed not just in the United States, but to readdressed in all the world. And I think we're far from that Minsky moment in the United States. As I said, this is the first time we've cut this much deficits. It still does not keep us in a path of what I would call real sustainability over a 30-year cycle, but it's a step in the right direction. So I think the markets have been stabilized because, okay, it wasn't the right way of cutting our deficit, but they did cut the deficits. So it's going to drag our economy, what economists say 50 basis points, 75 basis points. But I think what the overwhelming side is people are shocked how well the economy is doing, and so it's certainly going to be less of a problem. I believe the U.S. economy is in the best position of any Western economy in the world right now, which I could go into later on, but I'm not as worried about the situation around the deficits. There are other countries, Western countries, that have far greater problems with the deficits than the United States does now.
Okay, next question.
Hello, my name is Helen. I'm from Korea. Nowadays, many foreign investors are selling out their stocks out of Korea market. The question is, how do you see the new prospect of Korea investment market and any attractiveness? And if you can comment, what BlackRock plan to do?
Well, hey, I'm sure some of you know much more about Korea than I do, so I hope so. We have a nice business in Korea. I have a lot of my Asian investors sitting around me. I need them to wink and nod to me what we're doing in Korea. But from my perspective, Korea has done exceptionally well over the last few years. Korea benefited, in my mind, from a weakened Japan. Korea has benefited by a strong China. Now the situation in Japan has changed. I'm one of the viewers who believe what Japan is doing is, it might be the right path. So I know you asked me about Korea, but I think I need to talk about Japan to intersect Korea. I actually believe what the Abe government, for the first time in 20 years, there may be hope for Japan. If you think about, well, I use this analogy all the time, and I'd ask this question, I'll ask it again. I'm using this symbolically, so please bear with me for a second. Symbolically, how many people own products like Sony or other electronic products from Japan 10 years ago? Raise your hand. Okay, it probably looks like the majority of people. How many people today own Sony-type products today? So using Sony as an example, and Sony stock's up 100%, by the way, recently, which, but for the last 20 years, Japan has undergone a massive restructuring in terms of its society has gotten worse every year. You had deflation, you've had recessions, and you had companies who had to bear with a rising currency for 20 straight years, to the point where they had to cut costs dramatically, cut payrolls, and most importantly, cut G&A and research. And now with the plan of liquefying its monetary policy, which will obviously erode the value of the yen, the CEOs of corporations in Japan are pretty excited about that. For the first time in a long time, they have an opportunity to grow. For the first time in many years, they're going to be able to spend more money in research again. So for me, this might be the first time in a long time that Japan can reboot itself. And obviously, a stronger Japan, makes Korea on a relative basis. Korea will have more competition, and so that doesn't mean Korea is a bad place to invest. It was in the northern parts of Asia, it was just a highlight versus Japan. And now Japan has some opportunities for investors. I would also say Japan is probably the area in the world where people least amount invested. They're underinvested in Japan. So I'm not surprised that the Korean market has fallen, as people have probably moved, if you have an Asian allocation out of Korean stocks into Japanese stocks. And I just think that's a relative value investment. But I don't think that's a negative statement about Korea. It's a positive endorsement about the possibility of Japan breaking its 20-year syndrome.
Next question. Why don't we go here, and then maybe we'll come over here for the question after that.
Hi. Thank you for being here, Larry. It's fantastic to have you here, and thank you to Credit Suisse for being able to get him here. The question I have is, when most individuals invest, they look in their home country because that's what they know best. But given the cyclical trends and the secular trends, especially as we're seeing in Asia, how do you speak to investors to get them to understand the value of international investing, and where are you speaking to them about allocating those investments these days?
Well, that's happening. I think obviously you've said it, everybody has a home-based bias. But I think that's certainly in the United States, because the legacy of the United States, that's where everybody put most of their money. But we're seeing significant movement towards less home-based investing in the United States. I would say worldwide, our conversations with our clients from the Middle East to Latin America to parts of Asia and Europe, we're seeing more and more dialogue about investing outside their home base. We had some huge sales of Asian products in South America recently. Our largest sale of our Go Anywhere mutual fund, our global allocation fund, recently has come out of Asia. And so we are actually witnessing greater and greater diversification and less home country bias. I would say the amount of flows we see in ETFs is a real great example where you're seeing investors worldwide are looking to diversify. Every day I see a list of the top 10 flows in our ETF platform, and I see them where they come from. And it's generally not home-based bias at all. It is, you're seeing more and more changes. And I think that's one of the macro trends that people are miscalculating, how more people are looking for opportunities worldwide. And I think this is why ETFs are becoming that engine, because they're using some of this. I mean, one of the main reasons why we were so happy that we were able to buy Credit Suisse's Swiss ETF platform is because we believe Swiss franc is going to be a great opportunity for global investors. And now we will have a very credible Swiss franc ETF platform when we close this transaction in June. So it was about not just trying to sell Swiss franc products in Switzerland, it was about having more and more clients having an opportunity to have a liquid diversified product in different currencies, in different equity regions. And so we believe that will become more and more the norm.
Yes.
This is actually a follow-up question on your megatrend regarding rotation from fixed income to equities. How do you think that would actually work out, especially in America, when the whole generation of baby boomers are actually entering their retirement, and people may have historically been taught that fixed income are actually much safer asset than equities? And how do you think about that? Thanks.
Well, I don't expect to see a 65-year-old going from bonds to equities at all. So that's not going to happen. But I do believe if you're 50 years old or 45 years old, you have to, and your parents are still alive and they're in their 70s, and you start seeing that you're lucky you come from some good genes. You better start thinking about your allocation. You're going to be living longer, and so we have this syndrome here in Hong Kong. We have this syndrome in Europe about aging, and it is my proposition that we have just been way too reliant on bonds as a mechanism for it. And so I look at it and I ask a lot of people this: how much money do you need when you retire? and work backwards. And you say, okay, here you are sitting with a portfolio of bonds, and that's going to lead you to X. Well, you know, you're going to have a 40% gap of what you believe you need and what you're going to have. And now if you live an extra 5 or 7 more years, that gap is even greater. And so to me, this is the crisis. It's just we have tended to always have this bias as every year we age, we add more to our bond portfolio. First of all, we don't take into account longevity, so those tables are even wrong now. But importantly, in this, you know, when bonds were providing you a return of 7 or 8%, bonds were an excellent investment for retirement. And it provided you the internal rate of return, or that coupon allowed you to build that nest egg. You just can't say that anymore. So you can't have the same story of why bonds were so good for retirement when you're throwing off 3 or 4%. If you want to have that safety, as I said earlier, you are just going to have to put a larger component of your disposable income into retirement. Now, for those who want safety and for those who have the ability to add more of the disposable income into their retirement and put it in bonds, that's a very good strategy. But I would argue most people in the world do not have the ability to add another, you know, 3, 4, 5% of their disposable income and put it towards retirement. And that's going to be the problem. It's just math. So we need to address this. We need to educate, and we need to build up the consciousness politically and economically, because if we have that dialogue with our politicians, they will understand the problem we have too.
Next question. Okay, back here.
The Financial Times has been writing about in the last year how liquidity in corporate bonds has been drying up, that it's hard for people harder and harder to trade in a corporate bond once it's been issued. And I'm wondering what your thoughts are if interest rates do rise, how much confidence you as a fund manager in the market can have that if there are outflows that we can have reliable marks on mutual funds and ETFs and their bond holdings. Thank you.
Well, widening bid-ask spreads is very good for Brady's business, though. Oh, yeah. I can't, you know. It's very, we're in a transition now. You know, you have the Volcker Rule, you have Dodd-Frank, you have the Vickers Commission, you have all this stuff. You have Basel III. You know, we as society are asking the banks to change their business models. And part of their business model is how to be less reliant on the wholesale side of the bank. And much of that is the market-making capability. And then you overlay the Volcker Rule where they can't principal anything anymore. It puts much more pressure on us as investors. And when I talk to politicians all the time, and regulators, that's going to be the unintended consequences. We're going to have to live with wider bid-ask spreads because Brady needs to make a better return on equity to his shareholders. He can't take that principal risk anymore. I think this is just one of the unintended consequences of markets. I think this will ultimately lead to more products trading on exchanges. So I think we're in a transition period right now. I don't know what it is, 2 years, 4 years, whatever, whereby the market will find a way to create more liquidity. It's probably not going to be in the form of balance sheets of financial institutions. It's probably going to be in the form of more electronic trading and more trading platforms, not unlike the equity market. And so we are going to be in a period of illiquidity, and if the markets really have a snap in terms of interest rates going up, we're going to have periods of even greater volatility and probably wider bid-ask spreads. And I don't think our regulators are concerned about that. I think that's just one of the facts. But as bid-ask spreads widen, I think you're going to see more business move towards exchanges. And ultimately, it will be arbed out, and it'll work itself out. So I don't lose sleep on that. I just believe it's going to be a cost of execution. This is why, by and large, though, so we've had some very large pension plans come to us, and we have taken all their credits, all their corporate bonds, and redelivered them ETFs. And so I'm not trying to suggest the underlying of the ETFs will have periods of illiquidity, but they actually have less risk, idiosyncratic risk on any one bond, and they're trading around an index. And so that's going to be one of the big trends that I think you're going to see more and more bond managers using ETFs as a form of holding, especially during times of illiquidity.
We have time for a couple more questions. One here. Is there one back there? We'll go that next then. Yeah. Second.
So you talk about this asset liability gap, and that maybe one of the only ways to fill it is by people massively moving into equities to get longer duration. But isn't it possible that all that will happen in the next 30 years is that people will wind up changing the definition of retirement and working part-time until they're 75 or 80, and as a result that makes up the gap, and so this isn't really the crisis you suggest?
Absolutely, that's a great outcome. So I don't look at that as a problem if people do that, and if people are working longer, as I suggested, if people work longer, much of this gap is going to go away. So you're absolutely right on that analysis. I just don't see that behavior changing that much. But it still doesn't address the issue if you're 30 or 35 years old, are you going to own 3% bonds? So I actually think what your scenario is going to be an outcome of inadequacy. And what I'm trying to say is, okay, you got 30 years to get prepared. Do you want to work to 75? Because if you're not going to work to 75, you're going to be a burden on your children, or you're going to have to find another asset class to try to potentially earn that. So there's no question in my mind, people are going to have to work longer, but I don't know if that's an outcome most people want. And some of the people I talk to, they call that a real burden. That's something they did not want to do, and they didn't plan for it. And so if that is something that excites you to work to 75 part-time at pouring, at a 7-Eleven, if that's a reasonable outcome. All I'm trying to suggest is working till 75, whether you're working at BlackRock or 7-Eleven or Credit Suisse, hopefully you thought about that, and that's something you're looking forward to doing it. What I'm trying to suggest is if that's not one of your outcomes that you're looking forward to doing, you're going to have to find another, you're going to have to earn more so to avoid that outcome. And right now, I believe you're not going to get that. You're not going to get that desired outcome owning bonds. Look, here I am. I'm 60 years old now, so I'm frightened of retirement. There's no way I'm going home. So I'm going to work until 75. Maybe I'll be a great Slurpee pourer. I don't know.
We had a question back there. Is that right?
So just coming back on that point about the longevity, isn't that exactly what the Japanese faced 10 years ago, 15 years ago? And their reaction was to save more in bonds.
And that's why their economy has been a 20-year recession.
Absolutely, but what's going to make the investor not follow that same route? Why did the Japanese decide that, and the rest of the world is going to, when they face the same issue, decide to go into equities?
I am not suggesting they're not, but also I would not suggest that was the desired outcome the Japanese wanted. I think that was just what happened. And so what I'm trying to do is alarm people today and alarm all of us and alarm our politicians about that. That could be the desired outcome, or the desired outcome could be working until you're 75. If we don't address this now and talk about it today, we may have the Japanese outcome, or we may have every individual working to 75. And I don't think either one of those are great outcomes. And so I think if we have a thoughtful process of what we think about longevity and how we could avoid those two outcomes, I think people will reallocate at least a component of their portfolio to assets that can have longer duration outcomes.
With that, Larry, I want to take one last question. Okay, last question here, and then we'll wind it up.
Larry, I wonder how optimistic are you that Western-style democracy can deliver us the governments that we need to take some of the hard decisions, cut people's entitlements and so on, as contrasted with a number of governments in this part of the world that can take a 5- and 10-year view about the best way to go for their own economic development. It's very hard to get people to vote to cut their own entitlements.
Yeah, I think it's a mistake to say the democracy is not working. It's just messy and ugly. But no one said democracy's clean, and I think we're in a messy and ugly period, and I'm frustrated too. But I actually think, you know, the U.S. worked. We cut $3.9 trillion. We did it the wrong way, a lot of things. But I would also say, you know, the ingenuity of economies like the U.S., the education systems like the U.S., it's created companies like Google and Apple and Facebook and great manufacturing companies like United Technology and on and on and on. I actually believe it is because the foundations of democracy has created some absolutely spectacular companies, world-class companies that have survived for tens and tens of years. So I would not write off democracy. I would not suggest 10-year horizon economies is better or worse. They are different. But I would argue that despite my frustration in regulation and a lot of things, I would suggest that democracy is actually working. It's working well. It's frustratingly messy. But I would not trade right now the United States and where it's going, whether it is our banking system, the strongest banking system in the world. Our housing market has now really rebooted itself after a 7-year rough patch. And then our energy sector that is the envy of the world. And I believe that 9 out of 10 of you underappreciate what that is going to mean to the competitiveness of the United States. I think way too many times we focus on the old model. And the old model of having mass humanity manufacturing things cheaply is not going to be the norm for the next 20 years. We've seen a compression in wages. We've seen the robotics and improvement in manufacturing in which human labor represents a smaller component of manufacturing costs. And it is my proposition that energy cost and energy is going to be the major differentiating feature. And when you have $3.50 of natural gas versus $18 here, I would suggest the next 10 years the U.S. is going to have a revolution, a renaissance, not a revolution, a renaissance in manufacturing. That's going to be the envy. Well, right now we talk privately to a lot of CEOs. It is the envy. And let's see what we talk about the narrative of democracy in 5 or 10 years. And I'm pretty happy.
Larry, I think I speak on behalf of everybody when I say thank you so much for this exceptional opportunity to hear your thoughts and for you giving us that much time. So thank you very much. Thank you.